Hello, this is Joe Hoyle, the University of Richmond, talking to you again about intangible assets. This is our second video problem about intangible assets, and this one has a little bit of a twist. In this problem, your uncle comes to you and talks about buying a trademark, a logo, from one of their suppliers that they believe at their office supply store, if they're able to use this logo, this trademark, that it will tell the customers what good quality products they have. So they contact the owner of the trademark and agree that the price should be about $400,000. Now, if they were to simply write a check, this would be easy. We could do this in 20 seconds. We would increase our trademarks, we would debit trademark and credit cash for $400,000, and then we would write that intangible asset off to expense over its expected useful life, just like we would for equipment or a building, something like that. So that part would be simply normal accounting. But I wanted to add something to this question that was a little different, and that is the concept of present value. I find that students in college usually need to know quite a bit about present value, especially for their finance courses, because present value is so widely used in making business decisions. And usually, the first time a student comes across the term present value, or the time value of money, is in a financial accounting course. I normally find that most students need to see it a couple of times before they really come to understand it deeply. So what I decided to do when I designed this book was to cover the present value of financial accounting twice. I'm going to cover it here to begin with in intangible assets. And then I'll cover it again when we start talking about bonds and leases. And I believe, really do believe, that if you will stick with this here in intangible assets, and again when we talk about bonds and leases, that together you'll be able to have a good introductory understanding of present value. Here's where it comes into play. Your uncle talks the company into taking the $400,000, but not for 4 years. You're going to get the logo today. You're going to get the trademark right now, but there'll be no payment for 4 years. Immediately, the question comes up, why is your uncle paying the $400,000? If your uncle paid the $400,000 today, then the uncle is paying the entire $400,000 for that trademark. There's no argument. The trademark has a cost of $400,000. But what if your uncle is going to pay the $400,000 in 4 years? One argument would be that the uncle is paying part of the $400,000 for the trademark and the other part for the ability to wait 4 years about making a payment. Because if you can wait that long, you can save your money and be able to earn money off of it. So when the uncle pays the $400,000 in 4 years, are you paying for the trademark or are you paying for the ability to wait 4 years to pay? It's almost impossible to determine for sure what the uncle is paying for. Therefore, many years ago, in fact, while I was in college, the accounting body in charge at that time made a ruling that if you pay or collect money in the future and there is not a reasonable rate of interest being paid, and there's not here, he is simply paying $400,000 and not a penny of interest, then the official answer is that part of the $400,000 is for the trademark, for the principal, and the rest is to cover the interest. Now I know that the problem says they're not paying interest. The official accounting body says if you're paying money in the future, there has to be a charge for putting the money off. There has to be interest involved. So as the accountant for your uncle, you have to decide how much of the $400,000 is being paid for the trademark and how much is for the interest for that 4 years. That term is called the present value. So as an example, if the present value is $310,000, the present value is $310,000, then you're paying $310,000 for the trademark, and you're paying the other $90,000 for putting the payments off for 4 years. That's the interest. Now, usually, that actually makes pretty good sense. I'm getting two things. I'm getting the trademark now, and I'm getting to put the money off for 4 years, an interest factor. So the question comes out to be, if you're an accountant, how do you determine that present value? Well, fortunately, it's just a mathematical computation. All you're going to do is to take the future cash flows and you're going to mathematically back out or remove the interest for 4 years. Now, if I were you, I'd say, well, that sounds like a real problem. Luckily, there are tables that have already been mathematically set up to do this for you. So what you will do is to go to the table, or you could use a calculator, or you can use an Excel spreadsheet. In our book, we use tables for the most part because it's easy to see. And you can look up the right conversion rate or the present value factor. And that will allow you to take the interest out. It has been mathematically derived to remove the interest. And you need to know 3 things to use the table. The first thing you need to know is, what is a reasonable rate of interest? Because you're pulling the interest out, and you can't pull the interest out unless you have a rate of interest. So you have to come up with a reasonable rate of interest. For example, you might say, in this situation, 7% would be a reasonable rate of interest. That's the first thing you have to know to find the present value factor. The second thing you have to know is the number of time periods. I said in this problem that you're going to make the payment in 4 years. So if we assume a year is a period of time, then it's 7% interest for 4 years. And the third thing you have to know to be able to use the table is the cash pattern. There are typically 3 cash patterns available. One is simply a single amount paid in the future. You're going to pay $400,000 in 4 years. That's a single amount. That's a cash pattern. Or you have what's called an ordinary annuity. In an ordinary annuity, you pay the same amount every period, but the payments are at the end of the time period. So for example, if I buy the trademark on January 1 of year 1, and I pay $100,000 on December 31 year 1, December 31 year 2, December 31 year 3, and December 31 year 4, that's an ordinary annuity because it's the same amount in equal time intervals, and it's done at the end of the period. It's done after some time passes. And the third cash pattern is an annuity due. Equal payments at equal time intervals, but the payments are made starting immediately. So if I buy the trademark for $400,000 on January 1 year 1, and I pay $100,000 on January 1 year 1, January 1 year 2, January 1 year 3, and January 1 year 4, that's an annuity due. If you know those 3 things, a reasonable interest rate, the number of time periods, and the cash pattern, a single amount, an ordinary annuity, annuity due, then you can look it up in the table, or look it up on your calculator, or look it up in an Excel spreadsheet, and it will give you the conversion rate or the present value factor. If you multiply that times the cash flow, it removes the interest. It's a mathematical computation. So just as an example, if we look up the present value factor for 7% for 4 periods for a single amount, and if it turned out that that was 0.70, then we would multiply 0.70 times 400,000, and we would get $280,000. That's the present value. What does that mean? That means it's $400,000 in 4 years with the interest removed. So if your uncle is going to pay $400,000 for this trademark in 4 years, and there's no other payments for interest, and if our computation's correct, then he would be paying $280,000 for the trademark, and the other $120,000 would be recognized as interest expense over that 4-year period. Now, present value, I will admit, takes some work. It takes some practice, but that's why you take the course, to do the practice. We will cover this here in Intangible Assets to start you on the road to understanding the time value of money. In other words, future payments with the interest removed. And when we cover it again in bonds and leases, we will add to that knowledge so that by the time you finish this course, by the time you finish this book, you will know the present value information that you need when you get into finance courses and upper level accounting courses so that you can use these present value computations. Accounting has so many wonderful and interesting topics. This is Joe Hoyle. This is Intangible Assets. More specifically, it's buying a trademark with a payment in the future so that you have to record it at present value. Have a great day. Take care.